A retiree with $480,000 sitting in a traditional savings account is handing roughly $14,700 to the IRS every single year. Not because they did anything wrong, not because they made a bad investment, because nobody told them that the way you held money when you were working is one of the most expensive habits you can carry into retirement. And in 2026, it just got more expensive. There are 5 specific things that seniors are doing at the bank right now that are quietly adding to their tax bill, triggering Medicare surcharges, and in some cases, permanently reducing the amount their family inherits. I am going to go through all 5. I'm going to put a dollar amount on every single one, and by the end of this video, you will know exactly what to stop doing and what to do instead. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Jordan. Every week I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Mistake. Number 1, keeping too much cash in a taxable savings account. Most retirees have no idea that every dollar of interest their bank account earns gets added directly to their taxable income, with no deduction, no shelter, and no exception. Here is the IRS rule behind this. Interest income from savings accounts, money market accounts, and CDs is reported on Form 1099 INT. It is classified as ordinary income. That means it gets stacked on top of your Social Security, your pension, your RMDs, everything. The IRS does not care that you already paid taxes on the original deposit. The interest is new income, and it is fully taxable at your marginal rate. Let me put a dollar amount on this. Say you are 68 years old. You have $480,000 in a high-yield savings account earning 4.6%, which is roughly what top-tier accounts were paying in early 2026. That is $22,080 in interest for the year. If your combined income from all sources puts you in the 22% federal bracket, you just handed the IRS $4,157 in federal tax on that interest alone. If you live in a state like California with a 9.3% income tax rate on that bracket, add another $2,053. That is nearly $7,000 in tax on money sitting in a savings account. Nobody sat them down and showed them the actual numbers. Here's what most people do not know. If that same $480,000 were parked in a Roth IRA, even in the same high-yield money market fund, every dollar of that interest would be completely tax-free. Zero Form 1099 INT, zero marginal rate impact, and zero effect on your Medicare premiums, which we will get to in a moment. The action step. Work with a tax professional to review how much cash you're holding in taxable accounts versus tax-sheltered accounts. If you have Roth capacity, or if you converted in prior years, your liquid emergency reserve may belong in a Roth money market, not a taxable savings account. The consequence of not acting. Every year you leave that cash in a taxable account, you are paying federal and state income tax on interest you did not need to spend. Over 20 years of retirement, at even a modest 3% yield on $300,000, that is $60,000 in interest income, and potentially $13,000 to $18,000 in taxes, paid for nothing. Mistake. Number 2, ignoring CD ladders that trigger IRMAA. This one hits hardest for retirees between 63 and 72, and the damage does not show up until 2 years later, when your Medicare bill arrives and it is $900 higher than you expected. Here is the IRS rule and the Medicare rule working together. IRMAA, the income-related monthly adjustment amount, is a Medicare surcharge that applies to Part B and Part D premiums when your modified adjusted gross income exceeds certain thresholds. In 2026, for a single filer, the first surcharge tier kicks in at $106,000 MAGI. For married filing jointly, the threshold is $212,000. Medicare uses your tax return from 2 years prior to set your premium. So your 2024 income determines your 2026 Medicare cost. Here is the dollar impact. A single retiree with $104,000 in MAGI is paying the standard Part B premium of $185 per month in 2026. That is $2,220 per year. The moment that MAGI crosses $106,000, say, because a $15,000 CD matured and threw off interest, they jump to the first IRMAA tier, $259 per month. That is $3,108 per year. The difference is $8 annually for a single person. For a married couple, that same tier jump is $1,066 per year, just from one CD maturing at the wrong time. Most people do not know that IRMAA is not just about income. It is about your MAGI, which includes tax-exempt interest from municipal bonds, untaxed Social Security, and foreign income. A bond that looks tax-free at the state level may still be pushing your magi over an IRMAA cliff. The action step. Before you roll a CD or open a new one, project your MAGI for the year with your tax advisor. Check where you land relative to the IRMAA thresholds on the current Medicare schedule. If you are close to a cliff, consider timing the maturity into a lower income year, or redirecting that capital into a tax-deferred vehicle that keeps the income off your magi entirely. The consequence of not acting. A retiree who crosses one IRMAA threshold on accident, year after year, because of CD interest they never needed to spend, will pay an extra $888 to $1,676 per year in Medicare premiums for the rest of their life. Over 15 years, that is $13,220 to $26,640 out the door for a paperwork problem. Mistake. Number 3, taking required minimum distributions. Before considering a QCD, if you are 70, 12, or older and you are giving money to charity, even $50 a month to your church, your local food bank, or a cause you care about, and you're pulling that money out of a checking account, you are doing it the most expensive way legally allowed. Here is the IRS rule. A qualified charitable distribution, QCD, allows you to transfer money directly from your IRA to a qualified 501c or 3 charity. The amount transferred counts toward your required minimum distribution, but is excluded from your taxable income entirely. The 2026 annual QCD limit is $108,000 per person. The transfer must go directly from the IRA custodian to the charity. You cannot take the money first. It must be a direct transfer, and it is reported on Form 1099-R with a specific distribution code. The dollar example. A 74-year-old retiree has an RMD of $22,000 this year. She donates $6,000 annually to her church. If she takes the full $22,000 as a taxable distribution and then writes a check from her bank account, the entire $22,000 hits her taxable income. If she instead directs $6,000 of her RMD as a QCD, only $16,000 is taxable. At a 22% federal rate, that is $1,320 saved in federal taxes alone, without itemizing, without anything changing about her charitable giving. In a state like Minnesota, with a 6.8% income tax rate, add another $408 in state savings. Total, $1,128 saved per year. Here is what most people do not know. The QCD also reduces your MAGI, which means it can keep you below an IRMAA threshold, below the Social Security taxation threshold of $25,000 for single filers, and below the net investment income tax threshold of $200,000. One strategy, 3 simultaneous benefits. The action step. If you are 70, 12, or older and charitable, giving is already part of your life, call your IRA custodian and ask about direct QCD transfers. Get the charity's EIN number. Have the check sent directly. Keep the acknowledgement letter from the charity for your records. Report it correctly on Form 1040, line 4B. The consequence of not acting: every year you take your RMD in cash and then donate from your bank account, you are paying income tax on money you gave away. That is real money walking out the door every single year, money the IRS collected on a gift you already made. Mistake. Number 4, leaving a joint account without a reviewed beneficiary designation. Most retirees have no idea that the person listed as beneficiary on a bank account or CD will receive that money completely outside of their will. It does not go through probate. It does not follow your estate plan. It goes directly to whoever is named on that form, even if that form is 20 years old. Here is the legal and tax reality. Bank accounts with a payable on death, POD, designation transfer automatically to the named beneficiary upon the account holder's death. No court, no estate, no delay. But the tax treatment depends on the account type. For a traditional CD or savings account, the beneficiary inherits the full balance, and any accrued interest that has not yet been reported becomes part of the estate's final return, or the beneficiary's income in the year received, depending on when the interest was credited. The IRS rule here falls under IRC Section 691, income in respect of a decedent. The dollar example. A retiree passes away in March 2026 with a $90,000 CD earning 5.1% that was scheduled to mature in November. The $3,125 in accrued interest that built up between January and March is IRD, income in respect of a decedent. The beneficiary receives $90,000 plus that interest, and the interest portion is fully taxable as ordinary income in the year they receive it. If the beneficiary is in the 24% bracket, that is a $908 surprise tax bill on money they did not earn and were not expecting to owe. Here is what most people do not know. If your named POD beneficiary on a bank account is a deceased ex-spouse, a deceased sibling, or a child who predeceased you, and you never updated that form, the bank may treat the account as having no beneficiary, which kicks it into probate. The delay, legal fees, and court costs can run $2,000 to $5,000 for a modest estate. The action step? Go to your bank this quarter. Ask to review the beneficiary or POD designation on every account you hold. Bring your current estate documents. Confirm the named beneficiaries are living, are the correct people, and reflect your current wishes. Do this every 3 to 5 years, or after any major life event. The consequence of not acting: a 30-year-old beneficiary form can override a brand new will. The law does not ask which document was written most recently. It asks which document was on file at the bank. Mistake number 5, not withholding federal tax from Social Security. This one is the quietest trap of all, and it results in a penalty that most retirees never see coming until tax time. Here is the IRS rule. If your combined income exceeds $25,000 as a single filer, or $32,000 for married filing jointly, up to 85% of your Social Security benefit becomes taxable. Combined income is your adjusted gross income plus non-taxable interest plus half of your Social Security benefit. Most retirees hit this threshold, but the Social Security Administration does not automatically withhold any federal tax from your monthly payment. You have to request it, and you do it using Form W-4V, the dollar example. A 70-year-old retiree receives $2,200 per month in Social Security, $26,400 per year. Her other income, pension, interest, small RMD, totals $38,000. Her combined income is $50,200. At that level, 85% of her Social Security is taxable, $22,440. At a 22% federal rate, she owes $4,936 in federal tax on her Social Security alone. If she did not request withholding via Form W-4V, she's accumulating a $4,936 tax liability every single year with 0 payments made. When April arrives, she may also owe a failure to pay penalty under IRC Section 6654, the underpayment penalty, which in 2026 is running at approximately 8% of the underpaid amount. On an underpayment of $4,936, the underpayment penalty could add another $395 to the bill. This is not a mistake, it is math. Here is what most people do not know. You can elect to have 7%, 10%, 12%, or 22% withheld from your Social Security benefit. You pick the rate, you submit Form W-4V to your local Social Security office. Most retirees do not know this form exists. The Social Security Administration does not send it to you. Nobody hands it to you at retirement. The action step: download Form W-4V from irs.gov. Choose a withholding rate that roughly matches your expected marginal bracket. Mail or bring it to your local Social Security office. Review it annually, especially if your income changes due to RMDs beginning, a pension starting, or a large Roth conversion. The consequence of not acting: every April you face a large unexpected tax bill, and possibly a penalty, because your largest monthly income source was never set up to pay its share of taxes throughout the year. That is avoidable, completely and entirely avoidable. Here's what changed in 2026 that makes this different from anything you have seen before. The One Big Beautiful Bill, passed in 2025, introduced a $6,000 enhanced deduction for taxpayers age 65 and older, available for the 2025 and 2026 tax years for those who qualify under the income limits. That deduction phases out at $75,000 for single filers and $150,000 for joint filers. This means that for qualifying seniors, the taxable income picture in 2026 looks materially different than it did in 2024. Strategies built around the old thresholds, the old IRMAA cliffs, the old Social Security taxation bands, need to be recalculated. A retiree who was just over the threshold last year may be under it this year with the right planning. That is not a minor update. That is potentially $1,120 in federal tax savings on the deduction alone, plus the downstream Medicare and Social Security effects. If your advisor has not recalculated your plan against the 2026 numbers, that conversation is overdue. Let me bring it all together. Here are all 5 in order. Number 1, too much cash in a taxable savings account. That 4.6% interest is hitting your marginal rate every single year. Roth sheltered money market accounts exist. Use them. Number 2, CD ladders that spike your magi and trigger IRMAA. One CD maturity at the wrong time can add $888 to your Medicare premium for the entire following year, and you will not even see it coming until the bill arrives. Number 3, taking RMDs and then donating from your bank account. The QCD lets you satisfy your RMD and give to charity without the money ever becoming taxable income. The 2026 limit is $108,000. If you are 71-2 or older and charitable, this is the most overlooked strategy in retirement tax planning. Number 4, outdated beneficiary and POD designations at the bank. Your will does not override that beneficiary form. The bank account goes to whoever is named, period. Review it now, review it every few years. Never assume it is current. Number 5, no withholding on Social Security. Form W-4V exists for exactly this reason. If you are above the $25,000 or $32,000 combined income threshold, your Social Security is taxable. Request withholding before the next payment cycle, or face a surprise bill and a potential penalty every single April. 5 mistakes. All of them fixable. None of them complicated. All of them costing real retirees real money right now because nobody sat them down and showed them the actual numbers. This is Jordan Retires. If this video helped you, hit the like button right now. It takes 1 second and it helps this video reach more retirees who need to hear it. If you are not subscribed yet, hit subscribe and turn on the bell so you do not miss the next one. Drop a comment. Which of these 5 mistakes were you making before today, and which one surprised you the most? I read every single one, and the most common situations become future videos. I will see you in the next.